Watching crypto markets today, we have a lot of sideways movement and the lowest volatility in the history of Bitcoin. At the same time, we have a lot of impatient traders and investors trying to make profits all the time. The thing that I'm going to cover in this video might sound simple at first, but there is a good possibility that you missed at least one of the points that I will cover today, and this is also crucial to understand in order to make profits once the bull market occurs. Yo guys, my name is Željko and welcome to CryptoGrid. When you look into the crypto markets, the thing that I'm going to cover goes pretty much through all the aspects from trading, investing, yield farming, watching charts, accumulating different assets, their tokenomics, and everything that is related to crypto, and that's a connection of math and logic. Wait, don't quit the video, give it a chance. I guarantee you that some of the things that I'm going to cover in this video will be interesting to you. The reason for this is that the majority of the projects and everything that you see in the investment markets is some type of combination of math and mind games. This is why, despite of many attacks in the DeFi space, it's one of the segments of crypto that is always in the spotlight because of decentralization, obviously, and because of a consistent feeling of earning more tokens and more money passively over time. Projects always look at how they can release the project that everyone sees as a good opportunity. So they want to satisfy people who invest in the seed phase, people who come up after the project is launched, and the people who invest later as well. Besides the technological part of the project, this is one of the key things that distinguish successful projects from unsuccessful ones. So creators of the projects are always trying to create tokenomics of a project in a way that none of these groups sees themselves at a disadvantageous position or that the project is losing value over time, which means that they would be forced to sell. Instead, they want to create a perception within people that they are earning money by staking assets and other similar tools. I'm going to go back on this later, but first I saw some post that I thought was fake. So I made a poll on Twitter to see how many people would answer correctly, asking if you buy one coin of X for $100 and you sell it for $150, then you rebuy it at $200 and sell it at $250, how much did you make? Appreciate the answers. And that is the moment when I realized it is necessary to address this topic, since I was surprised with the number of wrong answers. If you analyze this question, you can see that there is one trade where you are buying one token worth $100 and selling it for $150, which means that you made $50 profit. And another trade when you buy one token at $200 and sell it at $250, which is again $50 profit. So you have $50 from the first trade and $50 from the second trade, which is $100 in total. Many people count how they lost the money in between these two trades, but they didn't. Why? Because they haven't been in a trade, obviously. And that's what many people don't realize, and they add minus $50 for a price increase from $150 to $200, which never happened because you weren't in a trade, as I said. And that is beautiful thing in crypto markets, that you can choose when is a good moment to enter and exit your trades and when is a moment to stay out of it and watch the markets from the side. Math is around us in crypto all the time. First thing to have in mind in trading, and another poll I posted, is that if you buy one coin of something and its price goes 6x up, you made 5x and not 6x because you invested 100% or 1x initially. As you can see on the pool, people are often too fast but inaccurate with these things. So if the project went 6x up, you need to subtract 1 because it's your initial investment. Also, you should always think if you compound on your trades or not, because you can often hear people speaking about how they earn 50% on a trade and then 10% on the next one, and if they don't compound, that would be 50% plus 10%, which is 60% in total, in comparison to 50% plus 10% of 150%, which is 15%. So the total is 50% plus 15%, which equals to 65, so 5% more. But this also means that if you lost 10%, you would be at 135 of the initial value instead of 140 without compounding. So pretty much compounding the numbers can both faster grow your portfolio and destroy it faster as well. Maybe the simpler example in trading would be if you have one winning trade of 20% and one losing trade of 20% also. Many people would think that you are at the initial value, but actually if you win 20% on $100, you are at $120. And then if you lose 20% on $120, you are at $96, which means that you lost 4% on the initial value. The same happens if you lose the trade first and then win the next one, since multiplying is a cumulative operation. This is the reason why people look at drawdown on each trading strategy, because if you have a series of positive trades, your position size will increase pretty fast, but if you get a few negative ones, your position sizes will decrease rapidly as well. This is why you hear so often that you should stick to 1 to 2% per position, because you don't want to have a 20% plus drawdown in your portfolio, since it becomes significantly more difficult to return it to the initial value after that. And it can always happen that you lose 5 trades in a row or even more. If you look into tokenomics of different assets, you need to be aware of the number of tokens in circulation in comparison to total supply, and how these coins are actually released, what's the staking API and inflation of the coins. One interesting thing about Bitcoin that people don't think of is that the total number of BTC that will ever be mined is 21 million. We currently have around 19.5 million Bitcoins mined so far, with an inflation rate of 1.8%, which will decrease after halving obviously. But one thing that people don't take into consideration is that by some estimations, around 25% of total Bitcoin that is currently mined is lost forever, which means that we have around 14.625 million BTC in circulation, actually instead of 19.5 millions, which means that the inflation rate is actually much higher, or 2.4%. Projects now often release a small percentage of their total supply, like 10% or even lower, which means that once everything is released, if demand remains the same, the price would lose 90% of its current value, which is insane if you ask me. Good example of these are layer 2s on Ethereum like Arbitrum and Optimism. Even Ethereum, which was expected to be a deflationary asset after the last upgrade, currently isn't because of the low network activity, so there are more coins created by staking than it is actually burned currently. You also need to be aware what's the amount of tokens that are actually unlocked. Sometimes it is once per year, sometimes it's every month, sometimes it's like 0.01%, and sometimes they're releasing 10% of the total supply into circulation, as they will do in the next few days. You can see that at token.unlocks.app, and no, this is not a paid ad, I just think it's a valuable insight and a good website. Same for staking, you need to be aware of when staking started, what was the API and at what price people bought in the project to be able to have an impression of when they might potentially exit. If you remember, there was a project called Olympus DAO, where you would double the number of coins that you have within a month, but the majority of the people didn't realize that if you have something like that, it requires a consistent inflow of new people in order to maintain the price. And if the number of tokens double, if demand remains the same, the price of the token will drop by 50% within that month. All this is especially important when you are looking at the potential of each coin, since you need to look when will actually be the top of the market. If you need to wait 2 years for it, and you have inflation of coins of 20% in the first year and 20% in the second year, that's an increase of 44%, which means that if the previous high was at price of $10 at 10 million coins, which is a 100 million market cap, That means in order to get to $10, again, we're gonna need to have 144 million of market cap, which is significantly higher, and that we're gonna have a price of $6.94 if we return to the previous market cap of 100 millions. Also, I personally worked at one project that was supposed to have a launchpad for raising funds, and they wanted to release the funds in their own token, and I was pretty much the only one in the company who realized how bad it is and how much selling pressure would that create once that project raise funds decides to sell like 500,000 to open market from the project that isn't that large in general. Firstly, they even wouldn't be able to sell all at once because of a liquidity issue, and the second, it would destroy the price in their native token completely. So there are so many things in crypto that are related to math that can both get you huge profits or completely destroy you. Many people think when they're creating their portfolios, what if they invest just 10 to 20% into some small caps, or what if they lose it in a high leverage trading in hopes of making some ridiculous gains. If you just 3x your portfolio in the bull run and 3x your portfolio again in the next bull run, you would be at 9x, which means that you made 8x profits if you followed everything closely in this video. If you lose 20% of your portfolio and make 3x on other 80%, you would be at 240%, and if you repeat the same in the next bull market, you would be at 5.76x, which is 4.76 on your profit, which means that you lost almost half of the gains in comparison to the first case if you do it with your whole portfolio. It's a huge difference. This just shows you the power of compounding and how careful you should be when it comes to losing money, and that capital preservation is the main thing for success in the financial markets. The fact that everything in financial markets is quantifiable is great, and it's something that you should take advantage of. If this thing scares you, you should rewatch this video and probably look more into the markets from this perspective until you understand it all and become familiar with it. I guess that the majority of you were aware of many of these things that I mentioned, but I also hope that I clarified at least some of them for you. I feel that often losses don't just come from not knowing something, but actually from not giving it enough attention. So always stay cautious. If you have any questions, you're welcome to comment below. Also, if this video was interesting to you, I recommend you to watch the video about compounding here, which pretty much adds up to this one. Also, please check the rest of the channel and please consider subscribing. Thank you for staying until the end. Stay strong and healthy. Bye.